Welcome to the Deep Dive. Today we're tackling a topic that definitely gets people talking. Often, maybe, with some confusion.
Yeah.
And as one of our sources puts it, pretty bluntly actually, it's seen by some as un-American, done by rogues, thieves, and especially pessimists.
Wow. Strong words.
Right. We're talking about short selling. It's something that always sparks debate, especially, when markets get shaky.
Mm-hmm.
And you hear calls to restrict it, even ban it. So our goal today is really to cut through that noise, understand what it's actually about.
Exactly. Because despite that reputation, it's a pretty fundamental part of modern finance, really.
Okay.
So our mission for this deep dive is to unpack how it works, look at the risks, the potential rewards too. We're leaning heavily on the book Short Selling Strategies, Risks and Rewards from 2004,
Right.
trying to bring some clarity for you, the learner.
Okay, so this sounds like it covers the waterfront, the basics, why stocks might get overpriced.
Yeah, and how investors might try to profit if they think a stock's going down. Not just, the basic short sale, but using derivatives too.
Derivatives, okay. We'll need to unpack that.
We will. And it also looks at the bigger picture, like portfolio management, how shorting might fit in, maybe improve returns, maybe even make the market work better.
But it doesn't gloss over the downsides.
Oh, absolutely not. The risks are definitely covered, and we'll be digging into those for sure.
Good. Okay, so let's get down to brass tacks. How does someone actually short a stock? It's kind of odd, right? Selling something you don't own.
It does sound counterintuitive, but basically you borrow shares of a stock. That's step one.
Borrow them. From who?
We'll get to that, but first, you borrow, then you sell those borrowed shares on the market.
Okay.
But here's the key. You have to return the same number of shares to the lender later.
Ah, okay. So the hope is.
The hope is you sell them now, say at $50, and then later the price drops maybe to $30. You buy them back at $30, return them, and you pocket the $20 difference. Minus costs, of course.
Right, always costs. So back to my question. Where do these borrowed shares come from? It's not like asking your neighbor, I assume.
No. Usually you find a lender through your broker. Lenders can be big institutions like pension funds, mutual funds, sometimes even other individual investors who hold the stock long term. Your broker facilitates this.
And there's a time frame. Like you sell, the buyer needs the shares.
Yeah, the standard settlement is usually 2 + 3, meaning 3 business days after the trade, the shares need to be delivered. Your broker handles that coordination.
Okay. And I've heard you need some serious skin in the game up front. Margin.
Absolutely. Initial margin. Think of it like a deposit. Regulation T, that's the rule, usually means you need to put up cash equal to 50% of the value of the shares you're shorting.
50%. Wow.
And that's just the start. There's also a maintenance margin. Exchanges like the NYSE, NASDAQ, they require you keep usually at least 30% of the market value as equity in your account.
So if the stock price goes up, trouble.
Big trouble. That's a margin call. Your equity drops below the maintenance level, and your broker demands you put in more cash immediately. Or they might liquidate your position.
Yikes. Okay, the book has this diagram, right? Showing the owner, the lender, the borrower.
Yeah, it helps visualize the flow.
Yeah.
The original owner lends shares, often via a securities lender, to the borrower, the short seller.
And money flows too.
Right. The borrower puts up cash collateral with the lender, usually slightly more than the share's value.
Oh.
The lender often pays interest back to the borrower on that collateral. That's called the rebate.
Ah, a rebate. Sounds good.
It can be, but, and this is important, if a stock is really popular to short, really hard to borrow,
Right.
that rebate can shrink, disappear, or even go negative, meaning the short seller actually has to pay a fee just to borrow the shares.
Ouch. Paying to borrow.
Yeah, adds to the cost. The book also mentions other ways lending happens. Big institutions might lend directly or set up exclusive deals.
Like CalPERS, the California Pension Fund.
Exactly. They apparently used an auction system. Ensures they get the best rate for lending their shares. Some big firms even have their own internal lending desks. Keep all the fees.
Makes sense.
Yeah.
Now, the book moves beyond just basic shorting. It talks about futures contracts. How's that a short?
So futures are another route if you expect a price drop. With a single stock future, you agree on a price today to buy or sell a stock on a specific date in the future.
Okay.
If you think company X stock is going down, you could sell a futures contract on it. Let's say the agreed price is $50 for delivery in 3 months.
Right.
If, in 3 months, the stock is trading at $40, the person who bought the contract from you still has to pay $50, but the stock's only worth $40. So you, the seller, profit from that difference.
And you don't have to borrow shares for this.
Correct. No borrowing involved up front. And most futures positions are closed out before the actual delivery date.
Oh.
You just take the opposite position. If you sold a contract, you buy an identical one back before it expires. Your profit or loss is just the difference in the contract prices.
Got it. And these single stock futures, they have specifics. Expiration dates.
Yeah, typically the third Friday of the contract month. Settlement usually involves physical delivery of the 100 shares the contract represents, handled through the DTCC.
Okay. And there's a formula in the book for pricing these. Looked kind of intense.
It can look that way, but the idea is simple. The futures price isn't a wild guess. It's tied mathematically to the current stock price, short-term interest rates like LIBOR usually, and any dividends expected before expiry.
Keeps things from getting out of whack between markets.
Exactly. Prevents easy arbitrage profits.
Okay, what about index futures? Like shorting the whole market.
Right. Instead of one stock, you're betting on an entire index, like the S&P 500. If you think the market's heading down, you sell an S&P 500 futures contract.
Similar mechanics.
Very similar. Buying and selling works the same. The main difference is settlement. Index futures almost always settle in cash, based on the index value at expiration. No physical delivery of hundreds of stocks.
And the book mentioned a big advantage for index futures. Costs.
Yeah, transaction costs are generally way lower than trying to short all 500 stocks in the S&P or even a representative basket. It's much more efficient for a broad market bet.
Makes sense. Okay, shifting gears again. Options. Calls and puts. How do they fit in if you're bearish?
Options give you more tools. A call option gives the buyer the right to buy stock at a set price, the strike price, before expiration. A put option gives the buyer the right to sell at the strike price.
The buyer pays a price for this, right?
The premium.
Exactly, the premium. So if you think a stock's going down, you could buy put options.
How does that work?
Let's say you buy a put with a $50 strike price. If the stock drops to $40, your put option is valuable because it lets you sell at $50. You can either exercise it or, more likely, just sell the option itself for a profit.
And your loss is limited.
Right. The most you can lose buying a put is the premium you paid. Unlike traditional short selling, where losses can theoretically be unlimited if the stock price skyrockets.
What about selling calls? That's another bearish strategy. You sell someone else the right to buy the stock from you at the strike price. You collect the premium. You hope the stock price stays below the strike price. If it does, the option expires worthless and you just keep the premium. Free money, kinda.
Kinda. But what if the stock goes up?
Then you're in trouble. If it goes way above the strike, the buyer exercises the option and you have to deliver the shares. If you don't own them, you have to buy them at the high market price. Potential for large losses there.
So, buying puts?
Yeah.
Limited loss, maybe limited profit compared to shorting. Selling calls, limited profit, the premium, but potentially huge losses.
Well,
different trade-offs.
That's a perfect summary. The book also talks about index options, like on the S&P 100, OEX, or S&P 500, STX.
It's rated in Chicago, right? CBOE.
Yep. And key thing there is they're usually cash settled. No actual stocks change hands.
And American versus European style.
Right. American style, like the OEX, you can exercise any time before expiration. European style, like the SPX, only on the expiration date itself. Small difference, but matters for strategy.
Okay. Last instrument the book covers, ETFs, exchange-traded funds. Anything special about shorting those?
A couple of interesting points. The fund's management fee can actually play into the lending economics. Lenders might factor that fee into the loan premium they charge.
Right.
But mostly, the loan premium depends on interest rate spreads. And if borrowing an ETF gets too expensive...
people find alternatives.
Exactly. They might switch to futures on the underlying index, or market makers might step in and actually create new ETF shares specifically to lend out. Arbitrage keeps costs somewhat in check.
And the book had this point about shares outstanding versus shares owned. That was a bit of a head-scratcher.
Yeah, it's fascinating. Because short selling creates new long positions without creating new shares, the total number of shares held in all accounts can actually exceed the official number of shares the ETF issued.
So more people think they own it than shares actually exist.
In a way, yes. Each short sale creates a new owner on paper, even though the underlying pool of shares hasn't grown. It highlights the layering effect of lending and shorting.
Okay, this is where, for me, it gets really fascinating. The book talks about how disagreement, divergence of opinion, interacts with all this. Edward Miller's ideas.
Right. Miller argued that you need to think about risk you can diversify away versus risk you can't. And crucially, how much investors disagree relates to both.
Okay.
His main point for us is when you combine that disagreement with restrictions on short selling, it can really mess with how efficiently markets work.
How so? If people disagree, but it's hard to bet against the stock.
Then the price might end up being set mostly by the optimists. The pessimists, even if they have good reasons, can't easily push the price down by shorting, so the market price might drift higher than a sort of average opinion would suggest.
And Miller said this causes financial puzzles, things standard finance theory struggles with.
Exactly. Things like why does non-systematic risk sometimes seem to get rewarded? Why are returns for beta maybe lower than theory predicts? Why do closed-end funds often trade at a discount? Even why mergers sometimes don't seem to add up financially.
Huh. The book uses a supply-demand chart too, right? Exhibit 6.2.
Yeah, a basic one. Demand is investor valuation. Supply is shares outstanding. Short selling effectively adds to the supply side of that equation.
Makes the supply line shift out.
Sort of, yes. It increases the available shares for trading, which can influence that market clearing price, potentially bringing it down closer to where a wider range of investors might value it.
And Exhibit 6.1 showed how wider disagreement can actually lead to higher prices if only the bulls are buying.
Precisely. If only the most optimistic fraction of investors are willing to hold the stock, and their valuations are really spread out, the price has to go high enough to entice enough of them to hold all the shares.
Sounds like the winner's curse.
That's a great analogy. The most optimistic bidder wins, but maybe they overpaid because their estimate was too high. In the market, the most optimistic investors might push the price up, potentially setting themselves up for underperformance later.
And this disagreement also fuels more trading and volatility.
Makes sense, right? If everyone has very different ideas about value, they'll react differently to news, trade more actively based on their own views, leads to more price swings.
What about the level of short interest itself? Does a lot of shorting signal disagreement?
The book suggests it can, yes. High short interest implies a significant chunk of the market disagrees strongly with the current price. And interestingly, studies mentioned suggest these high short interest stocks tend to underperform later.
So maybe the shorts are onto something.
Sometimes, perhaps. Another measure mentioned is disagreement among analysts.
How spread out their earnings forecasts are.
Exactly. High dispersion there might also signal uncertainty and potentially lower future returns, again, maybe because the current price reflects overly rosy consensus views.
Which brings us to naive strategies, like just assuming past growth continues forever.
Yeah, the points of that simple extrapolation is common, but earnings growth is actually pretty random. Past growth doesn't predict future growth well at all.
So people overpay based on unrealistic expectations.
That's the idea. Creates opportunities for shorts who dig deeper and see the growth story as maybe not sustainable.
And this fits with high PE stocks often underperforming, the glamour stocks.
Precisely. Those stocks often have high growth baked into their price. If that growth doesn't materialize, which often happens, the stock disappoints. Supports the divergence of opinion theory.
Okay, so we see why stocks might be short candidates. But the book stresses it's not easy. There are barriers.
Oh yeah, critical point. Finding shares to borrow can be a real practical hurdle. The lending market isn't centralized. It can be tough, sometimes impossible, especially for less common stocks or those already heavily shorted.
And regulations like the uptick rule.
That's another constraint. Historically, it meant you could only short on an uptick when the stock price moved up. Rules have changed, but the principle of trying to prevent shorts from hammering a falling stock persists in various forms.
Plus the costs we already mentioned. Margin, finding shares, paying dividends back.
Absolutely. Margin requirements tie up capital.
Yeah.
Locating shares costs time, maybe fees. You don't get to use the cash from the short sale freely. It's collateral. You have to make the lender whole on any dividends paid. And that potential negative rebate, it all adds up.
This leads to the Harrison and Krebs model the book mentions. What's the key idea there?
It's a really powerful insight, it says. Divergence of opinion, PLUS short sale constraints can create a speculative premium.
Meaning?
Meaning the price can get pushed above even what the most optimistic investor thinks the stock is fundamentally worth.
Oh, that sounds crazy.
Because the optimists can keep bidding it up, but the pessimists are blocked from effectively betting against it, so the upward pressure isn't fully counteracted. Paradoxically, making it hard to short can inflate
So
bubbles.
pessimists might just avoid the stock
Ah,
instead of shorting it.
exactly. If it's too hard or costly to short, they just won't own it. This can lead to ownership being concentrated among the true believers, the optimists, which further props up the price. Less selling pressure.
And companies themselves might try to make shorting harder, actively fight back.
Oh, yeah. The book cites research on this. Management might launch lawsuits, complain to regulators, do stop splits designed to disrupt short positions.
Even try to get shareholders to pull shares from lending programs.
Yes, coordinate a recall of shares to trigger a short squeeze, forcing shorts to buy back shares at high prices because they can't find shares to borrow anymore. That quote about shorting being mean, shameful, and loathsome shows the kind of emotion involved.
The three-compound example in the book really illustrates this, doesn't it?
It's a classic case study. Palm was spun off, but its market cap implied by its stock price was way higher than its value embedded within 3Com and higher than options suggested.
But arbitrage didn't fix it.
Apparently not easily. The cost and difficulty of shorting Palm stock itself seemed so high that it allowed this massive mispricing to persist for quite a while. The implied borrowing cost from options parity was astronomical.
Wild. Okay, let's pivot to portfolio strategy. How do active investors actually use this? Probably not for your average index fund investor.
Generally, no. Passive investors just tracking an index don't typically short. But for active managers looking for alpha, trying to beat the market, shorting is a key tool.
The book mentions enhanced indexing with short selling. What's that?
It's kind of a hybrid. You hold a core passive index fund, like the S&P 500, but then you also run an active portfolio where you short specific stocks you think are duds.
The idea being the shorts add extra return or hedge.
Potentially both. If you pick losers well, the shorts add alpha. And since individual stock movements aren't perfectly correlated with the index, it might offer some diversification or hedging benefit too.
Then there are more active strategies. Long plus short, integrated long short.
Right. Long plus short means you're actively picking longs you think will go up, and shorts you think will go down, often aiming for market neutrality. Integrated long short optimizes both sides together in one portfolio.
Trying to get alpha from both good buys and good shorts.
Exactly. It frees the manager from just trying to find the best stocks to own. They can also profit from identifying the worst stocks to bet against, expands the opportunity set.
Exhibit 8.6 shows how adding a short can actually improve the risk-adjusted return, the Sharper ratio. This seems odd.
It does, but it works because if the short position had a low or negative correlation with your long positions or the market, it reduces overall portfolio volatility significantly.
So even if the short doesn't have a huge expected return itself,
Its diversification benefit can make the whole portfolio more efficient. You get more return for each unit of risk you take. It pushes out the efficient frontier, allowing better combinations with risk-free assets.
but margin rules and collateral tie-ups affect how you build these portfolios, right? Because it's 8.7 and 8.8.
Absolutely. How much leverage you can use, how you balance long and short exposure is all constrained by margin rules, and how the short proceeds are escrowed. Those exhibits illustrate how allocation changes depending on risk appetite and those constraints.
What about market-neutral strategies,
Yeah.
equal dollars long and short?
That's the goal there. Minimize market exposure. Reg T margin rules actually help here, allowing you to establish both long and short positions with the initial capital, plus a liquidity buffer.
And you earn interest on the buffer and the short proceeds.
Yes, the cash collateral from the short sales earns interest, the rebate, hopefully positive, and so does the liquidity buffer. There is a cost, though, that haircut or fee for borrowing the stocks.
People worry about the risk of shorting unlimited losses. How do market-neutral funds handle that?
Well, the theory of unlimited loss on one stock is true. But in a diversified market-neutral portfolio, you hold many longs and many shorts.
So they balance out.
Largely, yes. The diversification helps, and managers constantly rebalance to maintain that neutral stance. It's extremely unlikely all your shorts would explode upward simultaneously without offsetting gains on the long side. Risk is managed through diversification and active balancing.
Okay, the million-dollar question for active folks. How do you actually find stocks to short? The book has that chapter, Spotting Clues and Cues.
Right. Digging into the quarterly reports. It's about finding companies, maybe playing accounting games or sacrificing the future just to make the next quarter's number look good.
Looking for red flags the optimists might ignore.
Exactly. Things perpetual optimists might gloss over.
Like what? Give us some examples.
Okay. Rising inventories relative to sales. That's a classic. Suggests they aren't selling stuff. Or maybe capitalizing costs into inventory improperly.
DSI days, sales of inventory going up.
Yeah, that metric.
Mhm.
Or declining bad debt expense when sales are flat or rising. Maybe they're not reserving enough for customers who won't pay.
Uh-huh.
Reducing depreciation rates arbitrarily.
Uh,
Capitalizing more costs like software development, or the book mentions pre-publication costs for publishers instead of expensing them immediately. All can boost current earnings but aren't sustainable.
and the book talks about running the business to make the number. What kind of tactics are we talking about?
Things like stuffing the channel, shipping tons of product to distributors at quarter end, maybe with loose payment terms, just to book the revenue now.
Even if it comes back later.
Or just steal sales from the next quarter. Using rebate vouchers cleverly to book full revenue now, but delay the rebate cost. Delaying necessary write-downs of old inventory or impaired assets. It's managing earnings, not necessarily the business, for the long term.
So the message is, be skeptical, do your own homework, don't just trust the hype.
Absolutely. Independent analysis, digging into the footnotes, questioning consensus views. That's where potential short ideas often emerge, finding where the story doesn't match the numbers.
The book also briefly mentions the economic profit, or EVA, approach, using that to find shorts.
Yeah, EVA looks at whether a company earns more than its true cost of capital. If a company consistently generates negative EVA, meaning it's destroying value.
It might be a short candidate.
Potentially, yes.
Yeah.
The idea is wealth-creating firms have a return on capital higher than their cost of capital, leading to an enterprise value greater than the capital invested. Wealth destroyers have the opposite.
So negative EVA, or limited growth in EVA, might signal an overvalued stock.
That's the concept. If the market is pricing in growth or profitability that the underlying economics, like EVA, don't support, it could be a short opportunity. Especially relevant when companies are expanding capital in low-return businesses.
Okay, let's bring this all together. Thinking about market efficiency, what are the big takeaways?
Well, it loops back to Miller's hypothesis. Divergence of opinion plus binding short sale constraints can lead to overpricing.
And the evidence seems to support that. High short interest, high analyst disagreement, lower future returns.
The evidence discussed in the book points that way, yes. It suggests these might be signals of overvaluation that persists partly because restrictions prevent shorts from fully correcting it.
What about that uncertainty-induced bias theory? Sounded complicated.
It's a bit subtle. It suggests that even if investors are unbiased on average, the process of selecting stocks, especially riskier ones where there's more uncertainty and disagreement, can lead to the chosen stocks having lower risk-adjusted returns than expected. It's a potential explanation for why high beta stocks sometimes underperform. The selection process itself introduces a kind of bias.
Interesting. And these restrictions and disagreements even affect things like mergers, whether 1 + 1 really equals 2.
Right. If opinions diverge widely on a merger's value, and negative views can't be fully expressed via shorting, the resulting market price might not reflect the simple sum of the parts. Optimism or pessimism, when constrained, can skew the outcome.
So wrapping up this deep dive, what's the final word?
I think it's clear short selling is, well, complex,
Yeah.
and definitely misunderstood often.
Yeah.
The mechanics involve borrowing, margin, collateral, and you can do it different ways: stocks, futures, options, ETFs.
And that interplay between differing opinions and the barriers to shorting is really key to understanding prices.
Absolutely. It affects market efficiency. For active investors, shorting offers tools, potential alpha, ways to manage risk. But it's not free. It requires real analysis, understanding the costs, the risks.
So this exploration, drawing on short-selling strategies, risks, and rewards, was really aimed at giving you, the learner, a much clearer, more informed view on this whole area.
And maybe it leaves us with a final thought to chew on. Given the potential market benefits, efficiency, price discovery, and the tools it offers investors, how should we think about the ethical side? Especially given that historical negativity, where's the right balance? Definitely something worth pondering further.